us run for people who are watching us, who follow us, and of course, a lot of our clients who have given us so much love over the last 6.5 years. We've been in operation running a buyer's agency. So I thank you so much tonight for you to take time out and actually listen to us to present why right now is the best time for you to invest. Before we get started, Primary Real Estate and its associated entities take no responsibility and disclaims all liability for any losses, damages, or cost as a result of use of any information presented today. And we are not any financial advisors, accountants, or brokers. Plus, at the same time, we're not giving you any financial advice. It's for education purposes only. Please make your own legal and financial investment advice. Speak to your professionals to be able to take that call. And past performance may not be indicative of future results. With that, I just want to introduce me and my company a little bit so that you have a bit of an understanding who we are and what's our creativity. So what we do matters because we are here to hold hand for clients to take them through and put their portfolio on steroids. All we're doing is trying to make things easier and to build portfolio for our clients in a different way. This is my journey. I've been in Melbourne for last 22 years now and started, you know, I came in here as a student. So I did my master's here in RMIT in electronic and telecom engineering. And then from there, after finishing that, been through corporate for 13 years with a large global organization, done multiple programs and projects at senior levels, and thoroughly enjoyed the journey during that time. But at the same time, there was something that was missing, and that was my quest for a business that I always wanted to do and do it for myself. So deep down, obviously, I knew property was my calling, and I actually built my portfolio along the way, made mistakes, learned the right way through education, and then I realized that how 1% investors really make money, and that's what it sort of struck that maybe there's a better way to help buyers. And then I got myself licensed and started the business in 2019, which is called Find My Real Estate. So the mission is very simple, is to help Australians achieve early modern retirement and giving them the lifestyle they desire. Now, this is something which is really very close to my heart because I truly believe in this and I want to make sure that, in some form or shape, there's ways that we can actually create passive income for people along the journey of building the right portfolio so that they can use the cash or additional cash for themselves, or maybe people looking for real retirement and actually rely on that passive income for them to retire soon. So when we've spoken to so many people, what we've come out with is what we understand that people come up with goals. And of course, everyone wants income ultimately from investments that they're making when they're retired. Now, retired doesn't mean that you're sitting at home. So it might be, as I call it, modern retirement. It may be more about what about if we actually need to do something to enjoy our lifestyle. So a lot of people that we've spoken to, I think they're happy with an average of about $150,000, give or take, on passive income in about 10 to 15 years. So again, we are not, as I said, financial advisors here, but this is based on what people tell us what their goals are. And then we look at, okay, how do we achieve that through property? So coming to the market, actually what we're talking about today is timing the market and exactly why is that so important. But first, let's look at the bigger picture about real estate. So our view is that real estate is too big to fail, and the numbers speak for itself. This is a $12.6 trillion market, and that's actually 3 times bigger than superannuation and 4 times your ASX. And the loan to value ratio is only 19%. So the outstanding mortgage debt is 2.4 trillion of the 12.6 trillion. So a lot of people actually right now, or even during the last 2.5 years, have been worried about that interest rates will continue to keep rising and properties will crash because obviously people can't hold the properties, but there's only a very small percentage of people actually having debt on properties, which is 19% of the entire population. So that tells you that it's not actually going to crash the way I see it. And at the same time, what we're looking at is that most people who are holding assets right now, they don't have debt. So there are 27 million people in the country. We got to look at the holistic picture of actually seeing how big is the problem when we're talking about high interest rates. Yet it does actually hurt a lot of families who do have the debt to keep servicing it at high interest rates. So I do acknowledge that. But at the same time, when we're talking about market crashing, that's a different view. Now, looking at the actual wealth being held in property, that's about 55% of Aussies are holding their wealth in residential property. And when you're talking about that sort of size of wealth being held, there are obviously a lot of people involved in property. In fact, property is the largest employer in the country. And and being $12.6 trillion market, what we're talking about, that not only the banks, but not only the government, everyone is involved quite heavily in property. And every second person obviously is linked with property in some form or shape. So that means that all layers of government would want to make sure that this sector doesn't go backwards. So, with that, of course, we'll get started. Now, the total sales, which means the number of properties that came for sales, is close to about 500,000 per annum. And the gross value of sales have been close to $508 billion that's been transacted over the whole year. So that's a lot of money that gets transacted. It obviously generates, as you can see, a lot of stamp duty as well. And that helps a lot of states to actually keep floating through the revenue that they get. So therefore, it is not in their best interest to get this sector going backwards. Now, again, with the macro view that we are trying to do here, if you look at the performance of actual property over the last 50 years, you'll get a sense of what I'm talking about. Now, last 50 years is a good sizable data to actually really see what's been happening. So these red bars that you see in the middle, they are all actually the 10-year period. So they're each decade. And you can see that home loans have changed values since 1970 until now. So there was 6.5 to 10% between 1970 to 1980, then 10 to 17%. So that was really at very high interest rate that people have actually paid interest rate at that stage. From 1990 to 2000, about 17% to 6.5%. And then we're talking about 6 to 9%, with now sort of close to where we now know where we are, between 5 to 7.5%, just around COVID and beyond. So you have had variable interest rates over the whole last 50 years, and so is the inflation as well. As you can see, I won't read through every number, but that's what we are saying. Yet, if you look at the green line, starting from 1970 to where we are right now, close to around 2025, the market just continues to keep going up, right? I'm not too concerned about the small blip here and there where markets may go down a little bit. But when you look at the overall macro view, long-term view has always been that markets always done better. And if you look at the decade view as well, your property prices have gone up 282% between 1970 and 1980. And even for the last 2010 to 2020, we're talking about the market is up 48%. Now, when I'm referring to market, this Australia is not just one market. There are so many macro micro markets within Australia. In fact, there are 15,000 suburbs across Australia. So each suburb, or the LGA, the local government area, where you've got cluster of suburbs as part of that whole area, is governed by its own market essentially. So you can't say that one market will go up, everything else will go up. It doesn't work like that at all. They all have market cycles within the micro and macro view as well. So, but broadly, when we look at it and we have a macro view, what we are saying is that at the country level, when we look at the property market continues to do well in long term. So, with that, what really drives these prices up, regardless of whatever events have happened, whether it's been COVID, whether it's actually have been GFC or any other event or wars in the past, what is driving the property market up in Australia, and why Australia is so different to any other country when it comes to property around the world? Number one factor is demand, immigration. This is the biggest element, and it is the lifeblood for property. As we continue to keep receiving more demand, more people keep coming in this country, we're not able to catch up enough on supply, and that keeps pushing the prices up with lower stock. Now, you might say, okay, well, if you live in a particular area and then there are lots of developments happening there, but there's not enough people there and there's a lot of land available, then you might be oversupplied in a particular type of area, but that doesn't mean that is a right now scenario across the country. A lot of markets across the country are in dire need for supply, and that's where the prices are being challenged at this stage, regardless of whatever is going on globally or locally. Doesn't matter what interest rates are doing, doesn't matter what consumer confidence is doing. Life is going on. People need to live, people need to move, and it's clear that the demand is outstripping supply at this stage, which has also been through all the federal elections, being one of the big agenda is to provide, as much as possible boost supply so that can actually meet demand. Second thing is employment. So we've had a very consistent employment, and I will go through that a little bit more for you. But it's also about the multiple industries that can actually get impacted during, things like GFC or maybe COVID. But how resilient Australia has been over the period of time, because we've always got government stepping in and actually supporting the different industries to make sure that they keep floating. Of course, apart from manufacturing, but there's been obviously a lot of other industries that have done quite well. Affordability is the biggest factor, I would say, probably from a demand perspective. So we'll talk about affordability a little bit more in the subsequent slides. Infrastructure, lifestyle, and education. These are like daily needs for everyone. We want infrastructure around us. We want to enjoy a certain type of lifestyle. Some people want to live near the beach. Some people want to live, you know, in the bushes. It doesn't matter. Some people love the metro lifestyle. Others don't, and they love to live in rural or regional areas. So we've had a very diversified way of how people move and where they want to live. COVID has shown that people don't like metro cities. They don't like crowded areas. They want to go away, and therefore we've seen a lot of movement, interstate migrations that have occurred. It is still happening, and the fact that this is going to continue to keep happening towards the lifestyle people want to achieve, that itself is very real. For the very fact that we used to go 5 days to office, 9 to 5 every single day, and now we prefer more working from home, is also a choice in lifestyle that most of us have got used to after COVID. So with that actually means that you want more services around you. You need to have more infrastructure that you prefer around you within the 2 kilometer zone, that you can do everything within the 2 to 3 or 5 kilometers radius, rather than actually going and traveling 25, 30, 40, 45 minutes, or even for that matter, some people are traveling 2 hours to an office in the city. So all that is all lifestyle, which means that we got to keep up with the infrastructure. We got to keep up with how things and how people want to move, live, and that basically means that there's a lot of pressure on governments to provide the right supply. Talking about supply, the incentives, the building approvals, property taxes, credit availability, land release, large developments. This is all about supply. How fast are these things coming in the market? Which markets are they being influenced? Which government, what projects or programs that government is running? We know that obviously at this stage, energy sector is obviously going to be booming a lot when it comes to renewable energy, and across the country, there are multiple projects, programs running of billions of dollars. And if you have access to that type of data, you can actually really try to see where you can actually buy the right properties and where the jobs would be created. But keeping that macro view of what is going on in the country can actually really help choose the right markets when it comes to investments, where the supply would be not oversupply, but enough that is actually going to meet the demand. So this is where supply demand makes sense. The third element is sentiments. Now, this is a big one because what happens is most of us being driven by emotions when it comes to property, we are also driven by fear at the same time. And sentiments matter with what is going on around us, what conversations are happening in the backyard, what are we reading every single day. Most of us are on the mobiles around at the moment, nowadays, and of course at the same time, we are exposed to so much information now that it can even be more confusing. If you're on social media, ask a question around in social media, you're probably going to get different responses for the same question, and that can put you into confusion mode. So media plays a big element in actually changing people's sentiments, right? And I'll show you some of the headlines that are happening right now shortly. Of course, there's a lot of hand in politics of how things will move and how they've been spinning. Budgets make a big difference into where the funds are going to go in from a federal and state government, and that can obviously pivot a short-term growth in those industries. Local and global economic considerations and conditions are really important. So that's where the RBA is obviously doing what they have to do. And we know the uncertainty that US brings at this stage across the globe, which is very real. However, we've been able to weather that right now with whatever is happening. Looks like it is getting stabilized, but yet to be seen. There will always be something globally happening or locally, but the resilience that property brings because of the demand, supply, and the continuous migration that happens, that is keeping this country going in the right way. So therefore, the policies are also modified along, in the last 20, 21 years, I've seen a lot of things changing. Home buyer grants have always got better, essentially over these years. But at the same time, we've also seen that as soon as there are grants that actually governments announce, markets already priced that in. What that means is that, of course, affordability becomes a question again for the first home buyer or anyone who has on a low income to be able to borrow money because that's already priced in. Now, we'll talk a little bit more about that. I'll show you some data around that. But it's important that people can actually live their life as normal and the interest rates are also lower and can actually go in hand with what's going on so that they can pay off obviously their debts at the same time there's enough cash flow to live their lifestyle. So that's been a bit skewed over the last 2.5 3 years because we are coming off the boiling point of the interest rates being so high over the last 2.5 3 years, and we'll look at the data as well and talk a little bit more about that. But there's also perceptions of people that also influences sentiments, like what's going to happen. What does this mean with interest rates going down? Or will they go back up again if anything changes? So, you know, people are thinking what they're thinking, but that doesn't necessarily mean that that's the fact. So I'll show you some data around what we think is going to happen and how things will improve. But over a period of time, when we look at that macro view that I told you and you keep that in mind as your foundation, you will always do well when it comes to long term. But in the short term, how can we achieve what we need to achieve? We'll talk about that. But this is really fundamentally the three things that really drives property prices up in Australia. And it's dependent on each other because obviously we want to make sure the consumer confidence is good so people can keep buying. So we'll talk about that a little bit more. Now that's the data from ABS. So we're at 27.3 million population as of 30th of September. What we've seen is a 7 million people or population growth in the last 20 years. Now, I've taken 20 years because that's probably when I came here in Australia, give a large. But the total growth just in last 1 year has been 484,000, which means that there has been a net migration, overseas migration of 379,000 people in this country in the last 12 months. And of course, there's been a natural increase of 104,000 people in Australia itself. So that brings up to the number of 484,000. So what you see in this graph is if you look at the blue line and the orange line there, that's talking about the numbers with net migration and the total growth. So the total growth is shown by the blue line. And if you look at it, it's in the last from since September 2004 to maybe 2019 before COVID. Mostly we've seen migration, overseas migration or total growth to be around between 300 to 400,000 people um, every single year. But we've had a bit of a dip during COVID, which we know. So no one was allowed to come in this country. So it was for a short period of time, likely about maybe 6 to 8 months or 12, depending on which state was being impacted. But that basically meant that it's almost like closing the faucet. And then when you suddenly open the faucet, you actually get a big boost in actual population coming in. And that's what's happened between the last 2.5 years. We've had a sudden migration that's opened up and just to balance out the years before. And we are now at a point where there's a decline in the total growth, but that is still sort of at this point in time above the average of the last 10 to 20 years, which is around 300, 350,000 people that we are talking about. So at this stage, what we see is that maybe this graph may continue to go towards that sort of range between 300 to 400,000, but it will likely come down to that point and stay there, which is really what has been historically the case, at least over the last 20 years that you see. So that's a good um, flow of people coming in the country that can be maintained over the years to get the economy going. And that's really where I think that that demand will continue to keep outstripping supply because we've had supply issues even 15 years ago, and that is still the scenario right now as new and new areas are being built out. Talking about unemployment, which is really at 4.1% as of April 2025, what you can say is that it is pretty stable at this stage and hasn't moved. So there was right after COVID when we had the high interest rates going up. The whole idea of high interest rates and keeping them at high rate was to bring inflation down. But what that also meant is that they actually that means that people would lose jobs. So they wanted unemployment rate to actually go up to the point that it stays there and the inflation starts to come down. So they've maintained 4.1%, which is really good, and that's actually helped them to bring the underlying inflation down. So we'll talk about inflation in a second, but that means that unemployment people increased by 2,100 to 618,000 people who are unemployed in a larger scheme of things, with close to around, maybe 10 to 11 million people maybe paying taxes at this stage. But yes, it's not great for people who are unemployed, but depending on the industry to industry, it could also be quite a temporary thing. But as interest rate starts to go down, hopefully businesses will become more stronger and they'll be able to employ more people, which basically means that unemployment rate will start to come down. So it's going to start balancing out. Inflation, we talked about this. So now inflation is really been the talk of the town for nearly the last 3.5 years, just after COVID. And that's really where the interest rates were really high to bring this down. So all it means is slow the economy down so the inflation comes down and we can have more sustainable growth in Australia. And that's actually done quite well over the last 2.5, 3 years. Whilst it had a sharp incline, there is also almost, if not as equal, but uh, if it's taken about maybe a year for inflation to go up to that point, it's taken probably a year to 2 years to so for it to sort of come down as well. So it's now sitting quite right within the 2 to 3% band that Reserve Bank wants, and that basically means that we are back to where we should have been before COVID, as far as inflation is concerned. Of course, there's still uncertainties as RBI has called out, and that will continue to keep happening. So it's a case of monitoring, but at least it's going in the right direction for all of us. And what I've shown below there is uh, the way the inflation is calculated is based on there's different inflation baskets. So there are about 11 different groups. And in 2024, the highest ones were housing, food and non-alcoholic beverage, recreation and culture, and transport being the highest groups that has caused that inflation to occur. But those things are actually getting in control now, the way we see it. So this is where this directly impacts all of us, which is interest rates and the cash rate for RBA. So what you can see is back in April 22, that's when the actual cash rate was 0.1%. And since then, from April 22 to November 23, which is a very, very short period of time, we've had 13 rate rises, which is 4.2%. The interest rate went up. And that is very steep for any household to absorb that and still keep afloat. And that's caused such a havoc in everyone's life to be able to sustain. In fact, a lot of people have sold properties or moved away just to sustain things or change jobs so they can get more money coming out of it, or people who have lost jobs during this period, businesses who have struggled to keep up with the interest rates have all that means is basically the economy was slowing down. People were spending less, people were spending more on mandatory items than non-mandatory items, and that's really where this was done intentionally to make sure that things slow down. So 4.35% as of November 23, and it stayed that way until inflation actually came down. And now we're at a point where, for the very first time since 2023, we are seeing two rate cuts back to back in the two RBA meetings that they've had, one in February and one in May. And we are now sitting at 3.85. So we've still got a long way to go. I think this should sort of sit close to around maybe 2%, 2.5%. If not that, maybe 3%. But a lot of talks are around. Lots of banks are also talking about it, that maybe there'll be another 2 or 3 rate cuts, which will probably happen in the next 12 months or so. But we'll see what happens. At this stage, the good news is that it's going in the right direction, and that's downwards. And we need that because we absolutely need interest rates to come down so we can get back our life, normal life that we had before COVID. Now, of course, when all of this is happening, there's a lot of question mark in people's mind. What is really going to happen? What is going on? What does this rate reduction actually mean? Is this enough for us to get to another wave of growth, or is it actually just temporary? Look, at this stage, the two rate cuts gives you a bit of relief into what we've been going through so far. We've had the highest inflation possible, so obviously we've been paying through our nose for our normal, even for that matter, shopping or groceries. Now, with interest rates going down, what that means is that if we've been very heavily negatively geared in our portfolios, we'll start to see some relief. It is not enough as yet that will actually absolutely go and uh, you know the property is not going to go berserk at this stage, but it is a starting point where a lot of people who've been sitting on the fence will start opening up to the borrowing capacities, which will help them give them a bit of a leeway to be able to, a cushion to be able to move around a little bit, refinance out, maybe restructure loans that can actually give them the right outcome for their existing portfolio. But slowly, gradually, as interest rate starts to go down this year, um, the heat will start to happen again. So that's where we believe that we're at the right point or at a cusp of trying to see how we could time the market and get the best benefit. So that's what we're talking about. Now, Tim Lawless, who I've been following since maybe the last 20 years, he is part of CoreLogic, and I always listen to him when he comes out with his monthly updates. And the recent news has been that, of course, as I said, we are back to the inflation target for between 2 to 3%. Both, I think, headline inflation and trimmed inflation is within this range, and that's a great news. That's what RBO wanted to see for all this last at least 12 to 15 months, and that's happened. That's great. Good news. We want to stay in that sort of band. At the same time, wages haven't risen, so that basically also means that the unemployment will probably continue where it is, which means that, of course, that things are in control as far as spending is concerned, which means they were quite confident to actually reduce this particular rate this time. On the right-hand side, what you see is what's the average been pre-COVID and where the cash rate is sitting. So the 10-year average is 2.55%, 20-year average is 3.93, and 30-year average is 4.96. So if we probably look at the last maybe 10-year to say 15 years, this is why I was saying that we need the cash rate somewhere between 2.5 to 3%. That's probably about right because banks will probably be adding up another 2%, 2.5%, depending on which bank you deal with. So we go back to that 5% or an average 4.5%, 5% type of interest rate rather than 6.5% right now, depending on which bank you're dealing with. So we want to make sure that the cash rate sort of comes to that point at some point in time between now and over the next 10 to 15 months or maybe 24 months. But as I said, it's going in the right direction. So if this year is alone, if we get another 2 or 3 rate cuts, that would be really awesome to see us sort of getting to the point of 1% lower than where we were at the beginning of this whole year, and that actually helps to elevate a lot of the pressure that people have had on holding their properties, or even for that matter, living their lives. Now, what Tim also mentions very clearly is that whilst there have been upward pressure on prices, this will offset the benefits of improved loan serviceability. So, of course, as interest rates come down, your loan serviceability gets better. But at the same time, because people will continue to keep buying properties and the affordability is always questioned, and there's so much demand, low supply, it's going to keep pushing and put pressure on property prices to keep going up, which means that the benefit that you're getting or the serviceability factor that we're talking here, and enough money that you can get from the bank, may not be enough to be able to buy the property because on one side we can borrow, on the other side the prices are going up. So you're actually questioning now the affordability part, that can I buy that property even though I can now borrow money? And that's really where I don't think there's so far, just with the two interest rate cuts, I don't believe that it's done enough to be able to still borrow enough money to be able to buy the property that you might desire, but it's going in the right direction. So this is consumer sentiment versus the actual volumes of sales for properties. So if you look at it, the blue and the orange uh, sort of goes hand in hand. There might be a bit of a lag with the property prices or the sales of it, but pretty much sentiments and consumer confidence, the consumer sentiments matters a lot when it comes to property sales. You know, if someone is over the last 2.5, 3 years, as interest rates were high, majority of the people were sitting on the fence doing nothing. Uh, some people have absolutely taken action and they have absolutely enjoyed the growth of property regardless of interest rates being high over the last few years. But a lot of people have turned off on that, and all they've been doing is trying to battle through their daily life and ensure that they can keep their head above the water and put food on the table. So what that meant is that a lot of people were not interested in property. In fact, a lot of people couldn't buy properties, so they've been renting, and a lot of people were renting, which means that we again have less houses to rent, and therefore renters have also gone through the roof across the country in the last year or two, and we've seen almost nearly anything from 8% to 15% rent rises as well in the last 1.5 2 years, and that is also in synonym with the increase in property prices as well. And this is all to do with more demand, less supply, which is really causing this to happen. So, coming back to the consumer sentiment, when people feel really optimistic about property and they really want to buy the property, the sales go up, and vice versa. So that's why it's absolutely in synonymous with whatever is going on at this stage. We can see, if you go almost at to May 25 on the right hand side, you'll see that the blue curve is starting to go up broadly, and the consumer sentiment is also sorry, the blue line being the consumer sentiment is going up, and the volumes of sales is also in synonym with it, which is really what it is now. Because we've just had the interest rate reduction or cash rate reduction. As soon as banks will start reducing those rates, and people will start seeing the benefit of that in their mortgages, people will start to refinance that out. So in the next month or 2 or 3, this numbers will start to look better, which means the sale volume should start to go up as well. And therefore, when we are talking about timing the market, it's important to read this data where we stand right now, and you start seeing the shift happening. We're already starting to get quite a few calls. A few people have just signed up for our services in the last 24 hours, and we can see that there is a movement already happening right now. Enthusiasm is building, but for a very small percentage of people when we talk about around Australia. Yet, the other biggest factor that really fuels sentiments is news. Like, what is happening? Is the media selling fear, or is the media now selling, FOMO? So it's really important to understand that. If you look at what Domain is saying, property prices could rise 141,000 with RBA rate cuts. Like, when you're reading all the sort of thing, the first thing is like, oh my God, the prices are going to go up again. So those who are going to be in the market, the first home buyers, the people who are struggling or they just on an average salary, they're thinking, how am I going to buy the property? Right. So there's a FOMO that's been created. And at the same time, this is real because it also triggers conversations in your backyard, especially on the weekend when most people are actually meeting their friends and family and they're talking about it, talking properly about what to do, how to do. And, you listen to your friends and family and are like, okay, well, we should buy property. And another one, your friend is saying, okay, yeah, I think that's a good time to buy property. And suddenly now people are starting to buy properties essentially, right? So really the media plays a big part in how people really swing their mood towards property and so forth. Another one, Nine News, double-edged sword: what interest rate cut may mean for house prices. Now, this is the domain chief of research and economics, Dr. Nicola Powell, who says that it is a positive thing because property prices will go up. But she also issues a caveat, and the caveat is that for the first home buyers, this could be a double sword edge. Whilst the rate cut helps with affordability, it could also fuel more competition in what's already a very tough market. And that is so true. We are already saying that there are multiple offers on properties. When we talk about investments in regional markets and a lot of metro markets as well, it doesn't mean that it's everywhere. There are chosen markets where the markets are going absolutely berserk and crazy at this stage. And what that means is, first home buyer who's looking to get into the entry level property, they're going to be priced out because you're still going to have to deal with investors and people around you. So all those government incentives that are actually going to help first home buyer get through this, given that now borrowing is going to open up for everyone, it also means that there will be more buyers and there aren't many properties out there in the right markets. Another one from realestate.com.au: will the rate cut heat up the winter property market in your area? So, questions like this, when you open up mainstream media every day in the morning, you're reading this through, you're like, maybe that is the case. That's going to happen. I should go and buy property, right? Financial review: Australia is on verge of house price boom, right? That's an opinion, but it gets you thinking. Another one, SBA News: RBA rate decision. Could today's rate cut worsen record high housing affordability? Right? So when these words are hitting on your mind every single day, and right now also, if you just type rate rise in Australia, what does that mean for property? You'll see a bunch of articles that will show up on Google, and it'll be all filled with this information, right? This is real. And this really changes sentiments for people. People who will get off, those who have been sitting doing nothing, they're reading this stuff every day, and they're like, okay, we should now make a decision and do something about it. So, where do we sit when it comes to market right now? And why are we talking about timing the market right now? Look, at this stage, I want to take you through a little bit about how the market has panned out just before COVID and up until now. You can see that the graph you see in front of you is the state graph of different states, essentially. The rate of growth that we have seen over the last likely 10 years or so. And what you will find is that there's there is more volatility just before COVID or around COVID up until now. So it's more like a yo-yo sort of thing, right? And that's followed a certain trend for a certain reason. Now, what happened is that in 2019, or just about mid 2019, we saw interest rates go down essentially, and quite fast. I think there were 2 or 3 rate cuts in about towards the second half of 2019, and that actually saw markets go up essentially, right? And because rates went up, you can see that within those two bands, the property markets went up because suddenly now you've got the borrowing. And that's exactly what I'm talking about now. We are in a similar phase right now. When you have these 2, 3, 4 rate cuts, you are actually seeing that markets move because people certainly have the money, as I explained earlier, and people can borrow and people will go in the market. The news channels are doing the job. So the sentiments are playing a big part, whilst fundamentally there is already more demand than supply. So when you combine those 3 factors, it is absolutely, you can make money in the right market if you were to time the right market at the right time. So that's just an evidence of when interest rates go down, what happens to the market all of a sudden. So whilst there has been a slowdown between 2017 to 2019 prior to this period, when you can see that how quickly the market catches up when interest rates actually go down. Then we had COVID. Now, COVID was a big thing from a health issue perspective. No one's thinking properly. They thought about 40%, market crash, 50% market crash. Those were the headlines at that point in time. No one cared because health was really real. We have a lot of people have lost their loved ones. So I'm really sorry. Apologies those who have gone through that period. But when it comes to property, this property is always a lag to react to any of those type of events. And what you can see there is that most markets did go down when it comes to rate of growth, but they were not negative in that position because demand continued to outstrip supply, and that continued to it meant that people had real movements that happened interstate during that period of time, and that kept the market going pretty much. And right after the fear was gone for COVID, things were more in better control towards the beginning of 2021. What we really saw, and those who made right decision to buy just before 2021 made a lot of money in the market. We're talking about in one single year or 1.5 year, markets going up 10, 15, 20, 30%. Even for some markets, even went up 40, 45% as well. at the property level. So that's insane. It's not sustainable. But when you time it, you've timed it well to make sure that can actually give you that initial jump, and then you can then pull the equities out and go for another one, right? Then what just happened is we've had rate rises, and that was when inflation went, skyrocketing out of anyone's hands, and that's when we've had this massive 13 rate rises that we talked about, and we've suddenly seen as soon as rate rises happened, and they happened really quickly in such short period of time, we've seen the rate of growth of markets come down, right? It's not necessarily that markets have gone backwards. A lot of markets actually, those are on high end of the market value. For example, 2 million, 4 million, 5 million properties, that is way beyond anyone's affordability as an average Australian. Those properties, obviously, and those markets are still in negative at this stage. But when we talk about affordable markets like 300, 400, 500, 600, 700K, they've kept themselves afloat. In fact, the ones on the lower end have actually gone up quite a lot. And therefore, when we've invested a lot of properties around the country through COVID period or right up till until now, we've seen regionals do phenomenally well because of affordability. And I'll talk about that a bit more in a second. So what we have seen is now rate rises have happened, then rates stabilized. There was no change, but it was still very high. And then people got used to that rate rise that, okay, we are now sitting at 6% interest rate or 6.5%, and that's what we have to live with. And we lived with it for nearly more than 12 months, which is where when life adjusts to that type of interest rate, people are still buying properties. And that's when, things are still going up. Most markets have still done very well. And we've had, for our clients, seen markets go up 20, 30% as well. And they've made really good money, right, in this period. Now, with interest rates coming down, again, there's market cycles with individual states. As you can see, majority of the markets like Adelaide, Perth, Brisbane has been now sitting at its peak, but there has been markets like Melbourne, Hobart, ACT, and Sydney, which is not at its peak, but at a point where it can start to grow. So, in fact, if you actually look at Melbourne market, it is showing negative 2% at this stage. And Hobart, which has had a really good run since 2015 up until 2019, just before COVID, that Hobart market did quite well during COVID as well. But then after that, there was a sharp decline in Hobart, and it actually struggled to keep up with the rest of the country, and therefore it is now starting to get back and get back to some level of growth. But there has been a decline, a sharp decline, whilst other markets did really well. Same thing when we talk about Perth, for example. Perth hasn't really moved over the last 15 years before up until COVID. And even during COVID, it did not do much. And what we saw is disparity in the median price point in Perth being one of the major cities as compared to other cities. And what happened was just after COVID, whilst everything else heated up and median prices rose of all other cities, Melbourne and Perth were obviously lagging behind. So Melbourne had its own issue with state government problems and the laws that came in that actually really killed the market. But and of course, Victoria didn't have much money, even now they don't. But that actually caused a lot of issues for investors to invest in Melbourne or in Victoria, and everyone started buying properties in other states. So Perth looked very lucrative, and all Perth did is a lot of catch up over these years. It hasn't moved at all, and the median price points of Perth has now come up at equilibrium with most of the cities. So this catch up happened just within the last 1.5 or 2 years for Perth. So that's where Perth really went up and was a leading market over the last year or two. And now we are seeing that there's a sharp decline in the rate of growth of Perth. It is still good, sitting at 9%, and 9% is really good rate of growth, but it's not insane like 20, 25% every single year. So that's how markets move. They move in cycles. We just have to really read through this timing. So those who look at this every single day can actually make sense of this. Those who are in this for like, okay, let's invest now, leave it for 10 years, don't worry about it. You don't have to. It's like, day trading versus actually you're a long-term trader when it comes to stocks. So property is sort of similar to that view. You can't really time the market what's peak, what's going to be bottom. Just exactly anywhere property is a lag to any of the events that occur, whether it's global or local. Yet, if you read a lot, you research a lot, you have enough data, you can still broadly sense that what's going to be the next move. And that's where we come in with our expertise to see what it is. As I said, with no surprise, as markets moved, we moved in different markets along the time, and we've seen some incredible results during this period. So 58% growth in 14 months. So 375K property went up $594,000 in just 14 months. 23% growth in 18 months. So $299,000 property went up to 369,000 with an estimated rent of 340. So these are just crazy numbers, right? They are actually almost unreasonable for anyone to see this, those who missed the growth, but those who actually really took the advantage have pulled equities out and have gone for multiple properties, right? So it's really showing you the results that if you did time the market, what could have happened in that time frame. And if you just think about it, around your area where you live, most people end up buying properties where they live within the 5 to 10 kilometers, and that itself is a problem. And if you did that, you do the analysis, you look at the last 2.5 years, and you can imagine that how much growth has happened in the last 2.5 years where you live right now. And you'll be able to relate what I'm saying. Because if you invested in another market, which you're probably not aware of, and had this type of growth versus where you live, there could be a significant difference in the outcome of your equities. So that brings us to the point of, as of the end of April 25, the CoreLogic data is talking about, it's a no-brainer, as I showed you earlier, that WA, SA, and Queensland have been the top three markets in the last almost 2.5, 3 years. And we have bought heavily in these markets in this time frame to really give that edge and advantage to our clients. Yet, where do we go from here? What do we do now? Should we still continue investing there? Is that still the right market to invest in? Or do we move to other markets? It'll come down to the strategy, and it'll also come down to individual risk appetite. But what I've tried to see is that this is PropTrack Home Price Index data as of end of April. So I've just tried to show you that the median values of each particular state, which is also the capital state, and it's obviously the rest of the state values, which is regional areas. So you can see regional data, and above is all the capital cities. There are median price values you can see. As I said, if you look at, for example, Perth, which is ranked at number 6 right now with a median value of 779, that was obviously around 400, 500 price point just about a year and a half ago, and it has caught up quite significantly. Brisbane is sitting on number 2 right now in median value, just after Sydney, which is 882,000 as a median value. That's absolutely insane. Melbourne's behind Brisbane, right, and behind Adelaide for that matter. Oh gosh, right? I mean, you can imagine that Melbourne really hasn't done much, and it is time for Melbourne to actually make the move. Yet, be very, 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 very careful and beware that Melbourne is a huge market. There are so many different suburbs. It is spread across. There's variety of things that when it comes to property in Melbourne, not everything is going to grow at the same rate, and therefore you have to really understand the demand supply. You have to really understand why those markets will go up. Whilst I'm saying Melbourne could be a good option, it doesn't mean that every suburb in Melbourne is going to be good. So you need a deeper level of research and expertise to really figure that out when it comes to the capital, Melbourne. But broadly speaking, at the state level, it is time for Melbourne to do something now. Hobart, as I showed you previously, it is starting to sort of show good signs of recovery now. And it could also be the point where you can see that it is not sitting at peak, but the change from peak has been close to negative 6%, 6 or nearly 7%, which meant that whilst it has had a 38% growth since March 2020, when it compared to Brisbane, Adelaide, Perth, it's nowhere close to 80% growth that's happened. So all these red ones could be an option for you to look at. But you definitely need more due diligence across the board to make sure that you have enough population in the area you're buying, there's enough infrastructure, there's demand, there's supply, and there's obviously sustainable demand that's going to help you, buy that property and keep that in your portfolio for a while. But We are seeing movement. We're not buying in NT, just to FYI for our clients at this stage, and of course, certainly not in regional NT at all that we are even thinking of. But this is just where the data is showing exactly how much change has happened and exactly how much it has grown since 2020. So COVID is, I think, a benchmark for a lot of this growth that we have seen, because majority of markets that have sat have not moved an inch or been dead for nearly decades. Those markets also rose during COVID. So I think everything did really well during COVID, and that's why it becomes a benchmark that how much has it risen since then. And it's pretty insane to see 85, 88, 90% growth, in markets with Brisbane, Adelaide, Perth. And that has happened only because these were very affordable markets at that point in time. Now it's questionable, because all of them have come to a point where it's equilibrium with each other, like 780, 800, 882. It's like in a band of 700 to 800. Majority of these markets are sitting with that, so they've all come at an equilibrium right now. So what does that mean? It means that now the next move can be quite equal for all markets, because it doesn't mean, because now someone who's looking to buy a property, if you just go by the median value in Melbourne for 781, in Brisbane for 882, in Adelaide for $800,000, people are thinking, where can I buy? Like for Sydney, obviously it's a clear choice. You don't have to buy 1.3 million. You can come into other states and still, buy at a lower end and still enjoy that your own home rather than actually reinvesting, because a lot of Sydney people do reinvesting as they can't afford to buy properties. Yet in all other states, they're pretty much at equilibrium right now. So if you look at the size of the actual state and the economy output and the GDP of a particular state and the jobs profile and the lifestyle it actually brings to you, the choices you're going to make where to live, based on whatever that might be. I love Brisbane's weather, but I'm in Melbourne for the last 21 years. So I still love Melbourne. I love the food. I love the culture. So it's hard for me to move, but I love to go out for holidays in Brisbane and Queensland, so I can enjoy the weather. But this is what I'm talking about, that what where are you going to invest next, right? What is going to be that market? Broadly speaking, any of those states are going to be okay at this stage. Yet what will make the difference is, what does your portfolio need? How are you going to make the next move? How much money do I have disposable to me to be able to buy the right property? And how far am I willing to invest? What is my risk appetite? These are the things that will actually help you make the right decision to choose the right markets for yourself. So when we talk about affordability, because this is the biggest factor, going back to this slide, which is talking to median price point and all of them being around this 700 to 800 mark for majority of the states, what we are saying is that if an average weekly earning is around $1,975 per person, or a full-time person working, an adult working full-time, what we are talking about is, what is the affordability for people to be able to buy a property based on the median values in particular state. So Darwin seems to be the most affordable based on the weekly earnings that you're actually seeing there. So it's sitting at 3.9%. If you look at the ratio, we're talking about ratio between the household income and the actual median price point of that state. Darwin seems to be most affordable. Then comes ACT, then comes Melbourne, then comes Hobart, and then Perth, Brisbane, Adelaide, Sydney. So Sydney is most expensive. So we know it's 9.8 times more than actually your average income for you to be able to afford something in Sydney. And therefore the choices become very easy. And when the affordability is there, people will go towards affordability. They're happy to go 5 kilometers out and live somewhere if they can actually buy the property 50, 60, $70,000 less than 5 kilometers in from the main city. So that actually dictates that particular behavior of why people keep moving out, especially if the geography is quite centric, and people will move in circles and outer circles to be able to get to affordability point. So that's what is showing. Those are the four states that we're talking about where affordability sits at this stage for a lot of people. But I'm not sure if somebody wants to go to a city right now to go into a job. But out of the four states, Darwin, ACT, Melbourne, and Hobart, I think Melbourne is a clear winner when it comes to you know uh, everything, the holistic view of where people would want to live. But again, this could be my view. I might be biased, but data is saying that it could be a choice if you want to live in major city. So I've done some numbers based on what it actually means. So let's say if you work on that particular weekly, average weekly earnings, what we are saying is that a couple is earning about $200,000 a year with that average weekly earning. So assuming that you can borrow 5 times of that money, which is about $1 million, and assuming that the loan to value ratio is about 80%, you can afford a property of 1.3 million with that money, knowing that you don't have any other debt, maybe no kids either. I'm not a broker or a banker, so please talk to them. So this is just for illustration purposes only. What that meant is that if I had to start something today, I've been renting all this time, and I can have 1.3 million borrowing, or I can afford a property 1.3 million with a borrowing of around $1 million, then maybe I can buy a property in Melbourne for around 700, 750 average price point that we saw, median price point. And then I can also have some more disposable borrowing to do investments, assuming I have enough cash to be able to buy these properties, and they don't have to be all done in the same time. It's actually saying you could probably spread that out into different times as well. So maybe over the next 2 or 3 years, I might be able to build a portfolio the right way, apart from having my own home. And by the way, it is not necessary you have to buy your first property to live in. You could straight away be renting and buying your investment properties, which are, as I said earlier, a lot of Sydney siders do because they can't afford to buy their own home. But just be careful with that, because if you're going to use first home owner grants, every state has different rules to it. So please look at that. Go to your SRO website, have a look at it. What are the rules? And then ensure that you don't actually forego your first home buyer grant if you're a first home buyer trying to reinvest. Now, the point is that with that affordability, and because it is capped and my incomes are capped, my borrowing is capped, how much I can buy a property is capped with that number. How do I still build the right portfolio? How can I still buy three, four properties when my income is not really going up? That's where the strategy comes in. That's where designing the portfolio comes in. That's where thinking of the right structures to buy properties come in. And there's a lot of advanced elements behind that goes about. It's not for today, but I wanted to show you that there are different strategies that we do, which is right from ensuring you've got cash flow balancing happening, you've got more incomes coming than you've got actually doing negative gearing at this stage. Right now every residential property is negatively geared in its standard form, unless you're running, rooming houses, Airbnb, commercial, India. So there are these other extraordinary type of strategies that can actually help you bring in cash flow. More cash flow means more income. Income going up means you can borrow more, but there's a way to actually structure this the right way and design the portfolio to be able to build the right portfolio for yourself. And that could also mean that you could go into a market which is, maybe there's a property for 300K, 400K, rather than buying something for 800K. So you could still put your foot through the door rather than actually waiting for that 800K to build up, as an example. So that could be another strategy. That brings us to the end of the session. Thank you so much for listening. I hope that was useful for you to get a sense of what it means to be able to invest for yourself. But at the same time, as I said, this is a webinar series, and we've just done a first one after a long time. I was very active doing all the webinars during COVID, but we are starting this whole thing again. The next one of this webinar series is going to happen on 5th of June. It is going to happen on a fortnightly basis. So the next one is called Show Me the Money. And that's where we are going to talk about how do I generate this cash flow that I need, even in this high interest rate market? What are the strategies? How do I balance my portfolio? I'm sick and tired of negatively geared properties. How can I make this work for myself? How do I balance my risk appetite to be able to do that and continue to grow the value? That's what I mean by Show Me the Money. So don't miss out. You will get the link for that. Those who have already registered. If you haven't registered as yet, please go to findmyrealestate.com.au/webinar, and you will be able to register yourself, and you'll be able to see this webinar when we bring the next one in. In the meantime, I am happy to switch to any questions that people have. So I'll probably sort of switch over and see if there are any questions for people. Okay, we've got one question says, some people say that immigration is a population Ponzi scheme subject to government policies over long term. What's your take? I don't. I mean, for me, I feel that maybe it's not a Ponzi scheme. We've seen that over the last 21 years or maybe the last 50 years, migration is the key. It's going to keep going on. Australia is such a large country. We are only on this. Broadly look at it. You're on all on the southeast side of it. You're all in the east side of the whole of Australia. Um, that's the heavily populated part of the whole country. There's so much more to explore in Australia. So I think there's so much more opportunities to be able to explore into different areas. And as developments will keep happening, governments will keep pushing in money for infrastructure to go into remote areas, and those areas start to spin up with good infrastructure. People will start to move there, and that's happening in real time right now. The immigration policies are all about don't clog up the cities, go into regional areas, and that's where everyone's been sent to get PR, and people are living there. So, and we've seen settlements happening in these areas now for way too long, and that becomes an established market. So essentially, it's all about trying to make sure that people can spread out in different parts of the country. And therefore, Perth has gone quite crazy in the last 2.5, 3 years when nothing was happening. So a lot of people are going directly to Perth as well to live. Although from investment perspective, I'm not so sure at this stage if Perth could be the right entry point. I'm not biased, but at this stage, I would probably say, you know, exercise caution and know what you're doing and where you're investing. Cool. That's probably, I think, those are the only questions I can probably see at this stage. One of them being there. Sorry, we had a tool issue, so we couldn't get into the other tool, but next one will be probably better. But thank you so much for listening, and I hope you all enjoyed. Have a good night, and talk to you soon again, and maybe see you on 5th of June as well. Thank you.